Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar series. Before we get started, let's take a look at the share disclaimer. Be aware that neither Dimitri, myself, or Market Chameleon are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, like all our webinars and shows, is for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer, one quick look at my grand piano, and we will invite Dimitri to the stage. How you doing, D?
Good morning, Will. How are you?
Good to see you, buddy. So today we're talking about analyzing historical earning gaps move. Is that correct?
Yeah, we're going to take a look at the earnings moves, but we're just going to analyze the initial gap, which is the earnings move measured from the previous day's close right before the earnings to the opening price. Okay. And let me come to a page where we could look at that example, and I'm going to use LULU as an example today. They're coming up with earnings soon, so let's just take a look at their historical gap moves. So we type in LULU in the search box, top. On the left-hand side, let's go to the menu, click on earnings, then select interactive charts. We'll come to this page. I'm going to close this menu to the left-hand side to expand this screen, and we have this summary page analyzing earnings moves from different perspectives. And we're going to take a look at the opening gap right here. So this here, if you click on it, it says 7.7%. That's the average move to the up or downside. So it's looking at absolute average terms. It's taking all the moves, positive and negative, converting them to positive and taking the average. And the idea there is to see the magnitude of the move in either direction, which is 7.7%. Let's click on it to get more details and data. And one of the reasons we look at the earnings gap move is that when a stock closes, reports earnings, then opens, it's a gap because there is a period there where the markets don't have regular trading hours. Options markets are closed. There's after hours trading, which is more illiquid. There is trading even pre-market, but that initial opening move is where the regular trading hours begins. Options markets start to open up, and that's where you get to start to hedge during regular hours, either your options or your stock. So what is that move, right? That's why we call it the gap move, because there's this period in there where we don't have continuous regular hours trading. And that move reflects the market's repricing based on an earnings announcement that happens, typically 4 times a year. You have 4 quarters that they release earnings. And it's important for traders who strategize around that particular move or that event. Either you're looking to do trades around that event or to manage your portfolio risk around that event. So let's first take a look at the data and what it shows us. And over here, we have some summary stats up top. And then we have the historical data down here. These bars represent the magnitude of the move. So they're all pointing up. And here's the percentage. So you could see here visually the distribution of the moves from the open to the close. The green bar represents that the move was up. The red bar represents that the move was to the downside. So this allows us to just quickly assess, and this dotted line is the average of all these moves, the absolute average, 7.7. And it allows us to quickly visualize the distribution of those moves. So we could see that even though the average is 7.7, there's a lot of variability around that average. We have some going way above that average, like these couple. Then we have some that are way below this average, right? So there's a big range there. So that 7.7, even though that's the average move, we see that there's a lot of variability. There's a big range around it. If we wanted to just look at the max and min, so we see that the largest move here is 21.6%, probably this one to the downside. The lowest is 0.3%. The median move is 6.9%. That's if we took all these moves, sorted them from highest to lowest in absolute terms, then half the moves were above 6.9%, half were below 6.9%. So you can see that the average is a little bit higher there, and that's because the average can get skewed based on some large outlier moves. In addition to that, we see the simple averages, and this is looking at all the moves, but instead of converting them all to positive moves, we look at them based on the actual moves, positive or negative. If we took the average of those, we see that it's positive 3%. So there is some bias towards the upside historically, with the biggest move to the upside 17.8%, biggest move to the downside 21.6%. That shows us that on the extreme sides, it could be very volatile, both up and down. Historically, we see that almost 18% to the upside, almost 22% to the downside. So that is a very wide range. That there's risks on those tails, right? You're looking at options. You're looking at risks to the tails to assess your potential reward, your risks. So you get a sense from a historical perspective of those extreme moves. The median move, so these are simple averages, is 3.8%. So that indicates to us that there's more, if half of the observations were higher than positive 3.8%. Okay, so more positive moves, half of them were below positive 3.8%. So there's a skew towards the upside. If we took a count or frequency of the up moves versus down moves, we see up moves exceeded down moves. 66% of the moves after reporting earnings were up, 34% were down. This little blue bar here, because the earnings is coming up, we start to reference the current option straddle that covers that earnings, and right now it is indicating 9.3% moving in either direction. Okay, so that's quickly looking at the historical data and trying to assess the opening gap distribution of returns, potential risks, and so forth. If we wanted to, for example, try to use this calculator below, and this defaults to the current straddle, 9.3%. But let's say we wanted to use this data and figure out, what if the straddle was 11%? What percentage of the historical moves fell below 11% gap, what percentage were above? So let's just say we put in 11%, like so, and we hit calculate. Now we have this 75% rank. That means that above the observations up above here, okay, in absolute terms, 75% of them were below 11%, 25% were above. So if you're looking at, a hedge or a strategy that was around an 11% gap move, now you have an idea from a historical perspective, the frequency of the times that the stock exceeded 11% at that opening gap, which is 25%. The 75% of the time it fell below. That's 11%. Okay, so that's a quick calculator to get those statistics for us. Let's say we wanted to narrow down our search further. We see that earnings, there's the next earnings that are coming up, I think tomorrow. Yeah, it says here March 27th after the market close. They're reporting the fourth quarter. So this is Q4. Let's look at the Q4. So we could take our data and narrow it down now to Q4. And when you click on that Q4, now it retrieves the data for only fourth quarter, and all these summary stats will get recalculated. So you could see here, this is March 2024, March 2023, March 2022, because you only have the fourth quarter happens once a year, right? So we only have one data point for each of these years. So going back to all the years, we see that the fourth quarter, the average absolute move was 9%, with a maximum of 21.6, min move 2.7, median move of 7%. These are the simple averages. So we could see that it still has a slight upward skew of 1.4%, but not as much as all of our data. Right? So look, you could compare it to all the data. You can see here, all the data shows a little bit larger skew, but the move, the opening gap move, 7.7% versus a fourth quarter of 9%. So the fourth quarter seems to have, averaged a higher magnitude of moves on average. Let's check the median. The median here is 7% versus 6 points, so similar, okay, on that front. But let's go back to the fourth quarter. We get to see the range is as high as on the upside 15.2%, biggest down move 21.6, median move 3.7. The up move still exceeded the down move 64% versus 36. So this allows us to compare the data set from our entire data set versus the fourth quarter to see if we see anything significantly different. It's very similar. I don't think that statistically this will be a much, something very different necessarily, but we could get at least compare it to see if we see something like wildly or very a large difference. Let's go back now to all. We could also narrow this down by the number of years, because is there something different in our data set in the, let's say the last 2 years than in all the years, the last 6 years, 4 years? So we could narrow down, let's say, to 4 years to see if these numbers change, because this is going back to 2014, right? Over 10 years. Let's say 4 years. So 4 years here, just eyeballing looks very similar, right? With the averages around 7.3, median 7.7. The up moves versus down moves are similar. Let's narrow it down to 2 years. So 2 years, it looks like that the average moves were a little bit higher, 8.9% versus 7.7%, with a median move of 9.6. So it looks like, we had a little bit larger moves than than the wider data set in the last 2 years. So maybe it's trending higher, the magnitude of the moves, than historical. The skew tended to still be biased towards the upside based on the average returns, median returns, and frequency of up moves versus down moves. Doesn't mean it will be, but that's where it tended to happen in the last 2 years of our data set. Let's come back to all and see how else we could look at it. What if we looked at the up moves versus the down moves separately? Okay, do we see something different? Like, here's the absolute average, but what if we just looked at the up moves? If our strategy was towards upside liquidity, right? That's where the strategy is. I don't know, an upside call spread or whatever you're looking at to upside liquidity. Let's look at that and see if it's different. So up moves. So here, these are only up moves, earnings gap, and when it was up, we could see that the average on average was up 8.1% versus the average move of all of them was 7.7. The median return was 7%. The average was 8.1. This is the range. These will all be similar now because we're only looking at up moves. So if we compared up moves versus down moves, you can see that the down moves average down 6.9% versus up moves. So this shows us that just looking at the up moves alone, those moves tended to be larger than the average down moves. Okay, so if we're looking at the skew, how the skew lines up, how the call spreads line up, put spreads line up, how does the iron condor line up? Well, we have a sense of the skew in the distribution of those returns. Okay, let's go back to any now. This here shows us when the entire move for the day was up versus the entire move for the day was down. So here we could see that even when on down moves for the entire day, sometimes you get opening up gap. So basically what this is saying is that there was a time where we opened up but finished lower on the day, but that only happened 13% of the time. Okay, there's two times here that we had a small open to the upside but finished down on the day. As far as up moves, there was 4% where we finished up on the day, but the opening gap was down. Okay, so that just kind of gives us a sense where how many times did the stock actually reverse from the opening direction and finish in the opposite direction on the day, right? Which is, you could see, very rare, but it's happened, right? So even if it opens up, there's a chance that the stock closes down on the day. Even if it closes down, there's a chance that the stock could actually close up on a day. It's rare, but it's happened. So I'm going to stop there because I do have to leave earlier today as well. I have a 9:30 appointment, but I think we covered pretty much everything on this particular tool.
Well, that was awesome, D. Thank you so much for bringing that webinar today for us. Remember, everyone, to like us and follow us on Facebook, YouTube, everywhere we're active on social. Great job as always, D. We will see everyone tomorrow. Have a great trading day. Thanks, D.
Thanks, everyone. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, chameleons. Everyone have a great day. Bye-bye.